Hello investors, welcome to the channel where I talk about investing for the long term through investing in companies that pay a dividend. This is known as dividend growth investing. My name is Michael, and today we're going to start off with looking at how the market ended for the week and then look at stock futures. Just taking a quick look at the major indices for the week. For the S&P 500 index, it is up 1.58%. For the NASDAQ index, it is up 2.21%. And lastly, for the Dow Jones Index, it is up 1.02%. So another good week in the stock market because everything overall went up in value, mainly because it appears that the coronavirus scare is starting to die off due to efforts in China containing the disease and other countries around the world doing everything possible to stop the spread and cure the infection. Now, that's the main portion of the news I'll be covering in this video. For the next portion of this video, I'll be covering some sort of blueprint, mainly for anyone wanting to start investing. Ideally, the earlier an individual starts to invest, then the results will be much better. Now, let's preface this by saying that you're starting to invest as soon as you graduate from high school. Whether you decide to attend college or not is really up to you because you're the one who should be deciding the outcome of your life. Regardless of that, everybody should have some method to generate income. The method for generating income falls under two categories: linear income versus residual income. With self-employment, you have your own business and you're the center of daily operations. With employment, you work for somebody else. In either case, these are pretty much the types of linear income methods that you have because essentially you are trading time for money. On the other hand, when you have residual income, this is when you get into the process of either being a business owner or an investor. And through this, you have residual income because you use leverage as a business owner to have people make money for you through a specific system. Now, for this channel, we'll be mainly focusing on becoming an investor, where we create passive income using the money that we have and using that money to work for us. Being a business owner and investor are types of passive income because these income does not necessarily depend on our presence being there on a daily basis. In any case, anyone can make money by working a part-time or a full-time job, or having a side hustle such as driving for Uber, DoorDash, Postmates, Lyft, selling items on eBay, Amazon, Etsy, Cafe Press, or doing tasks on TaskRabbit, Fiverr. One can also be a pet caregiver on Rover. One can also do babysitting on the side through care.com. The list of ways to make money can go on and on and on. Generating income is important because having money gives you the freedom to do certain things. If you're interested in learning more about how to generate income, then I'll leave a link below of the video to a book called Rich Dad, Poor Dad by Robert Kiyosaki for you to read on your own time and digest this information further. Now, once you have money, it would be good to create a budget to follow so that you can understand where your money is going and keep the majority of it. For simplicity's sakes, I suggest you follow the 50-30-20 template, which was popularized by Elizabeth Warren in her book, All Your Worth. Ideally, once you know how much money you make every month, you prioritize the usage of that money in 3 different categories. The first category involves 50% of your income going things that you need. Things that you need include housing, food, transportation, insurance, communication, and clothes. These are basic necessities you require in order to function in daily life. The next 30% of your income includes things that you want. And this would include things such as dining out, any forms of entertainment, shopping. The 30% of your income can go to things that are considered as unnecessary spending. Finally, the remaining 20% of your income should go to your savings and your debt. Now, there are two types of savings. The first type of saving is short-term savings. Short-term savings include things such as an emergency fund, which involves your health and your method of transportation, such as a car. At minimum, in an emergency fund, you need at least $1,000 to start. And you want to build your way up to having at least 3 to 6 months of living expenses in the form of cash. In addition, short-term savings can also involve having money for vacations, holiday gifts, furniture, and appliances. The next part would be having 20% of your income to go towards long-term savings. Your long-term savings include things such as your education and your investments. Things that involve education involve school, online courses, and books, while things that you invest in would include your stocks, bonds, and real estate. The remaining part of your 20% of your income should go to things such as debt. Debt includes things such as your credit cards, your student loans, your car loans, and your personal loans. Now, something I advocate when using the 50-30-20 rule is automation. Automation is a system that uses various processes which limit undesirable behaviors while promoting desirable behaviors to help your future self in terms of finance. Automation requires you to have your budget in place for your long-term goals and your short-term goals. Keeping your long-term and short-term financial goals in mind will help you plan out your budget, and automation will help you meet those budgeting requirements. After you have a budget in place, it is easy to automate your money. Let's take a look at how an example can be used to automate one's money. So this is a flowchart of how to automate your income. Let's say you have a job and you get a paycheck. That paycheck, before you receive it, can go to a retirement plan by your employer if it's offered. Otherwise, it will go straightly to a checkings account. Now, normally, you can go into your checking account and set it to withdraw money from this checking account into other small accounts, such as a savings account, for different purposes. One thing that I do every Monday after receiving my checks on Friday is to have money withdrawn from my checking account into a high yield savings account where it will earn interest while just sitting there, not doing anything. And I can use this high yield savings account as my emergency fund. However, I can also use that savings account to use it for paying my housing expenses, or taking money from a checking account and paying for my bills for the month, or have it go into my investment accounts such as my Roth IRA or my taxable investments accounts, or if you want to save up for something such as a vacation or buying a expensive purchase, then you can also send the money that goes from your checking account into another account, which you can later use it to pay for your high purchases. This is actually very important because automation allows you not to have to think about which bills you have to pay or which investments to make, because it's more or less already done for you. So let's use an example of how this would work. Let's say you have a job and every 2 weeks you make $1,000 after taxes are applied in the form of a paycheck. That paycheck will go into your checking account. And using the 50-30-20 budgeting method from before, $500, which is 50% of that $1,000 that you received from your paycheck, will go into things like housing, food, clothes, and transportation. 30% of that $1,000 equates to $300, which will go into things such as paying credit card bills from everyday expenses, memberships such as your subscriptions to the gym or Netflix and other bills, and the remaining 20% of that $1,000 will go into things such as your emergency fund, your retirement plans, your investment accounts, and your short-term goals, as well as your debt that you have in outstanding. Now, here's the real exciting thing about the 50-30-20 template. It's easily customizable for every person. Let's say you're able to save money on your transportation method because you bought a car that works well outright for a very affordable price, and you're able to save on shelter because you either live at home for free with family, live with a lot of roommates to split housing cost, or house hack your home because you bought a multi-family home which you live in one and rent the rest of the other 3 to tenants who pay you to cover for expenses on the house. Well, that's money saved from the 50% designation, which you can use in either of the other remaining slices. Obviously, for this channel, any money saved will go towards the savings pie and specifically allocate into investments. Ideally, the purpose of this budget is to get towards a point where the majority of an individual's income is going into assets, things like stocks, bonds, and real estate, and not liabilities, such as a mortgage or an auto loan, a student loan, credit card debt. Simply stated, assets are entities that put money into your pocket, while liabilities are entities that takes money out of your pocket. Now let's use a visual to understand how assets and liabilities work. This diagram here shows the cash flow of people who aren't very good with their money. These are people who earn a specific amount of income and they use the majority of their money on certain expenses such as rent, utilities, cable, fuel, insurance, entertainment, and emergencies. In addition, they use a lot of their earned income to buy things which are liabilities. In this case, they use it on their cars and things that require for the car to be operational, such as maintenance and gas. In addition, they consume a lot of consumer goods which don't help them increase their income. And because they spend all their money in their liabilities, they don't have any money to put into assets. Therefore, their overall net worth is very low. Now, compare the mindset of people who are considered to be in a poor household to people who are within the middle class. People who are in the middle class have a cash flow of pretty much similar things. They have a higher amount of income which they use to pay for their expenses, and because they have extra disposable income, they put a majority of that income into liability, things that take money out of their pockets. As you can see here in this diagram, liabilities that the middle class have involve their mortgage, their vacation, their auto loans, having just stuff which don't produce them money and instead cost them extra money, which funnels back into here, even more expenses. And once they have so much expense, they don't have enough money to put into assets, things that create them money. Now, let's compare this to the third possibility. This is the cash flow path of people who are considered to be wealthy. If you're a viewer of this channel, this is where you want to be. I would imagine that your goals would line up with this scenario, but perhaps you're starting off in either scenario 1 or 2. With this channel, my hope is that everyone can learn how to develop methods which permit them to be in a financial situation as comparable or better than this third scenario. In most cases, you have a method of earning income, whether it is a small amount or a large amount, but the majority of your income are not going into your expenses, but rather you invest those things in your assets. Assets are things that you can use which generate more money. In this specific example, the higher amount of income earned is put into assets such as rental properties, which an individual can use to collect rent from their tenants, and this is passively earned. See how this amount of property here is being obtained through rent and creating passive income for the wealthy earner. This passive income can then be used to buy more rental property, which is used to create more passive income, and the majority of that passive income can be reused again to buy either more assets in property or in stocks which pay a dividend and go into appreciation to earn even more money. And this loop keeps going on and on until you have created a system where you're earning so much money that you can use some of that passive income to begin paying for your liabilities, stuff that you want, even pay for your cost of living. And all of this isn't done through the income that you earn, but rather you're using passive income to subsidize for those expenses. And in order to achieve this third scenario, one has to live well below his or her means by cutting back on expenses from the needs and wants category in order to put the majority of the earned income into the savings category. Now, in the savings category, there are many modes of investments, but I'm choosing dividend investing because of its compounding effect. Let me show you the wonderful power of compounding interest. Now, let's say you're a viewer of this channel and you're at the age of 20. You recently just graduated high school and are entering college. At this early stage of your life, you can only invest in a Roth IRA, which currently has an annual contribution limit of $6,000. Now, let's say you start off with $6,000 and every year after the age of 20, you continue to put in an additional $6,000. You're putting in a amount of $6,000 because that is the maximum current contribution limit for a Roth IRA. Now, given that you do this for 40 years, and you continue to contribute at least $6,000 annually, and you have an interest rate of only 6%, and we're using 6% as a very conservative number because it's considered extremely low, since the S&P 500 index, which is one of the standard indexes used to measure the stock market, has an average growth rate of between 7 to 12%. Then, starting at the age of 20 and going forward 40 years to the age of 60, you would have accumulated a net worth of over $1 million. Now, let's think about that. After 40 years passed of contributing only $6,000 for those 40 years, you would have only contributed $2,400,000 into the stock market, but in the end, you come out with over $1 million. That's the beauty of compounding interest. For this example, I'm using the age of 20 and 40 years of investing at that specific age because when an individual reaches the age of 59 and a half, then they can withdraw all of the profits in a Roth IRA and it's tax-free. Obviously, every individual is different, so his or her situation will be tailored and different to him or her. One suggestion to finely tune planning for a retirement account is to use a compound interest calculator such as this one and adjust these numbers to fit with one's own specific needs. Of course, a Roth IRA makes a lot of sense for people who are younger because most likely you're not making a lot of money in terms of your annual income and therefore you're taxed at a lower tax bracket. This means that very minimal amount of money is lost up front due to taxes, which mean that you have more money left over to invest. In addition, since you're young, you'll have a lot of decades for compounding interest to take effect on your net worth. This means more money should be invested early on so that compounding interest is more impactful and make your net worth even higher. And let's say you're not 20 years old, let's say you're 30 years old and you have a retirement age of about 60. Well, if you start at 30 and you're getting to the age of retirement when you're 60, that means you only have 30 years to invest. And at a interest rate of only 6%, let's say you keep that the same and you keep everything else the same. Well, if you had waited 10 years to invest, you would only have made half of what you would have had you invested 10 years prior. So the takeaway here is that the longer you wait to invest, the lower amount of net worth you will have in the future. And to make the next point more impactful, during your time of investing, you should imagine yourself as a broke college student. Now, this is something very personal to me because a few years ago, when I was attending college, I barely had enough money to scrape by every week. That meant that budgeting my money was extremely important. This entailed that I had to be financially responsible to even consider myself being cheap or frugal to others. This meant that I had to make my own meals or eat instant ramen for days on end unless there was free food on campus, just so that I had money to spend on essentials such as transportation, my education, my housing, and anything else extra that can be put into savings and investments. Now, if you have made it this far into the video, I'm going to link below special portfolios that I use to invest additional money that is outside of my Roth IRA. This, however, is a disclaimer because my portfolio takes a long time and effort to research each company in order to know when to buy, hold, or sell stocks. In addition, my results and your results with the same portfolio may differ incredibly depending on when something is bought or sold. Therefore, if you don't want to actively invest in the stock market, then you can passively invest in the stock market using a 3 or 5 exchange traded fund portfolio of stocks, bonds, and real estate, which I will also link down below for everyone to see. The purpose of the 3 to 5 ETF portfolio is for people who just want to automate their investments on a weekly or monthly basis and dollar cost average their way into the stock market in order to have a peace of mind that their invested money will grow with the market, so capital appreciation is available in addition to the dividends paid out by holding each fund. For example, in this benchmark right here, this is a 3 holdings ETF. It holds funds from Vanguard. This one right here, VOO, is a ETF that holds and tracks the S&P 500. VNQ is an ETF that tracks real estate in the United States, and this one right here, BNDW, is a ETF that tracks the bond performance of all the bonds in the world. And as you can see, it has done pretty well for the 1-year mark, the 3-year mark, and the 5-year mark. Compared to this ETF right here, this has 5 holdings. It has the same 3 as the one before, but also it invests in the international stock market and the real estate market outside of the US. And it has also done pretty well for the 1-year chart, the 3-year chart, and about the 5-year chart as well. So if you're unsure of which stocks to pick, I suggest using an ETF that tracks a certain market and just put in some amount of money into it every week and just have it automate itself. That way, no matter what happens, at least you're still investing in the stock market and have the potential to make capital appreciation as well as earning dividends while not having to do a lot of work. Lastly, something that I want everyone to consider is to avoid bad debt and lifestyle inflation. Things that involve bad debt are often considered as consumer-based purchases and are considered liabilities. However, education can also be considered as bad debt if the student loans that are borrowed are considered to be left unrepaid because the degree earned isn't highly marketable. For example, if you want to attend college to obtain a degree in something useful that will make you more marketable, like engineering, computer science, law, or medicine, then go to college and excel as much as possible. However, if you want to attend college to obtain a degree that's not as marketable, such as underwater basket weaving, then perhaps reconsider college. Keep in mind, college at a minimum is between 3 to 5 years of commitment on average and can be much longer. This means at minimum 3 to 5 years of time is spent on education, an opportunity cost that's extreme because an individual could have used that time and money to do something else that's profitable. Now, the next thing that I would like to talk about is lifestyle inflation. Lifestyle inflation refers to an increase in spending when an individual's income goes up. Lifestyle inflation tends to be greater every time an individual gets a raise and can make it difficult to get out of debt, save for retirement, or meet other big picture financial goals. For example, this is sort of the cycle it revolves around. You have a job and you work really hard to get ahead, and because of your hard work, you get a raise. And because of that raise, you now have extra money. Now, what most people do is often use that extra money to increase their spending on things, mainly liabilities, and this forces them to live paycheck to paycheck. And again, because you're low on money, you have to work really hard to make even more money to try and get a raise to have that extra money. And again, you use that money to increase your spending. And again, this leads you back into the cycle of where you will always be working extremely hard to make money just to spend it all, rather than just working hard, having extra money, and putting it into something that will make you even more money without having to work so hard. So let's give you an example. Let's say you're starting out making $20,000 annually, drive a beater car that doesn't cost much, live at home with your parents, and made your own home-cooked meals every day. Then you get a promotion at work or change jobs, and now you're earning $40,000 annually. However, instead of driving your beater car, you go out and buy a new car from a dealership and take out an auto loan to help subsidize the cost to reward yourself. In addition, you decide to move out of your parents' home because you can't bear living with their annoyance and now live in a one-bedroom apartment and pay $1,000 worth of rent every month. Furthermore, since you're busy with work, you decide to consistently eat out every single day and now spend an average of $200 a month for restaurants alone. But you continue to work, live off paycheck to paycheck until you get another raise and now earn $80,000 annually. And again, after earning this new salary, you decide to reward yourself by buying a house, buying a fancy car, utilizing a food delivery service, and anything else you desire. But here's the funny yet sad thing that happens. Even though you're earning 4 times the amount of money as when you first started, you're still barely scraping by and saving the same amount of dollars as you would have when you started. This is a prime example of lifestyle inflation, And the only way to avoid this is don't change anything about your life if you happen to make more money, except invest in the difference of money that you make. So, for example, let's say you went from earning $20,000 to $80,000. That is a difference of $60,000 that you could use to put into the stock market and let compounding interest take its effect and earn you more money. By keeping your spending the same as when you earned $20,000, when you earn $80,000, this gives you a lot of wiggle room in order to achieve financial freedom. Now, let me show you how I practice what I preach and show you my investment account for the week. Now, with the extra income that I make, investing the difference is pretty much my action plan when looking at my portfolio. So this is my portfolio currently. For the week, I am currently up $87.10, which gives me a return of about 0.97%. Looking at the results for this week, my portfolio is currently underperforming the market. However, my portfolio is not too far behind, and I'm confident it will be able to match up and outperform in the following weeks. So this past week, I invested over $400 into my Roth IRA to buy shares of a couple of companies, and I bought these companies because I believe that they were at a very good price. So on February 10th, I bought 5 different companies at these prices. I bought BGS Foods, Royal Caribbean Cruises, Tootsie Roll, AOS Smith Corporation, New Corp. I also bought even more Tootsie Roll, New Corp, Shire Energy Partners, ExxonMobil, Simon Property Group, DuPont, BDX, BG Foods, BP. And on this day, bought a lot right here. Bought all these companies because I had some extra income that I wanted to put some use into the stock market, because this following Monday is a federal holiday and the stock market is closed. So I just wanted to put in as much money as I could in order to buy some shares before the market ended. Now, I bought all those companies because I thought they were at good prices for me to dollar cost average my way into my targeted positions. And furthermore, on a fundamental level, all these companies are pretty solid for the future of their business. All these companies that I've bought pay a dividend for holding shares, and ideally, these dividends are set to increase over time. So as long as these companies pay out a dividend that increase over time, so that compounding interest can take effect, then I will continue to buy shares of these companies at a great price. Now, looking over to my dividends tab, this week I earned a decent amount of dividends from various companies, which I can use that money to reinvest in my portfolio. Looking down here, I earned 8 cents from Air Products and Chemicals. I earned 11 cents from American Express. I earned 23 cents from Texas Instruments, 4 cents from Nucor, 10 cents from Apple, 61 cents from Phillips 66, 94 cents from Western Midstream Partners, 1 cent from Abbott Laboratories, $3.86 from AbbVie, $1.54 from Shire Energy Partners, 35 cents from Clorox, 7 cents from Colgate, 6 cents from Mainstream Capital, 6 cents from Northwestern Natural Holdings Company, 6 cents from Omega Healthcare Investors, 35 cents from Realty Income Corp., and 21 cents from Stellus Capital Investment Corporation. All these dividends that I earned right here are a result of me owning shares of each company. This is money that I did not have to put any effort into earning besides clicking a few buttons to buy shares. Essentially, this is the passive income that I'm earning while I'm asleep. This is passive income, which refers to earnings which are derived from an enterprise like a rental company or a property which require little to no effort to earn and maintain. Although these amounts may seem very small at first, every little bit helps and will eventually snowball into something bigger through compounded interest. So this concludes the update portion of my portfolio. Thank you so much for everyone for watching this video until the end. If you liked the video, then please give it a thumbs up as it will help the channel grow immensely. If you have any comments or questions, then leave them down below of the video and I'll do my best to personally address it either in the comments or answer it in future videos. I greatly appreciate everyone watching my videos and I hope to speak to you all again very soon.